In an evolving landscape where cryptocurrency continues to blur the lines between traditional finance and digital innovation, recent developments highlight significant shifts in both regulatory scrutiny and market dynamics. The recent focus on decentralized finance DeFi within the XRP Ledger XRPL is particularly noteworthy as it signals a growing demand for truly decentralized financial solutions amid increasing concerns over the safety and transparency of centralized platforms. On May 7, 2025, reports surfaced revealing that Democrats are intensifying their scrutiny of former President Donald Trump's ventures into cryptocurrency, including his family's crypto empire and a meme-based coin he has been associated with. This political spotlight on crypto assets underscores the intersection of governance and digital finance, where regulatory frameworks are struggling to keep pace with the rapid evolution of blockchain technologies. As political figures take aim at crypto ventures, the implications for market sentiment and investor confidence could be profound, potentially influencing the broader crypto market landscape. Simultaneously, the cryptocurrency market reacted positively to the renewed optimism surrounding U.S China trade talks, which coincided with a notable rise in Bitcoin prices. Analysts suggest that the bullish sentiment has sparked increased interest in various cryptocurrencies, including XRP, as investors look to capitalize on potential gains. This resurgence in crypto prices is not just a fleeting trend, it reflects a more profound shift in investor sentiment, particularly towards assets perceived as resilient in uncertain economic conditions. Amidst this backdrop, Xpfinance has emerged as a pioneering player within the XRPL ecosystem, launching the first fully decentralized non-custodial lending and borrowing platform specifically designed for XRP holders. The platform addresses key concerns regarding asset custody and centralized risks, which have become increasingly pertinent in light of recent high-profile hacks and insolvencies in the crypto space. The rapid growth of XRP's user base, fueled by institutional adoption and strategic partnerships, has created an urgent demand for decentralized financial solutions that align with the core tenets of blockchain technology: decentralization, transparency, and self-custody. Central to Xpfinance's offering is the introduction of the $XPF token, which serves as a utility token within its ecosystem. This token promises not only governance participation but also reduced borrowing costs for holders and potential passive income through staking, thereby fostering a community-driven approach to financial services. The pre-sale of $XPF is set to commence on May 8, 2025, offering early investors a unique opportunity to participate in a new financial paradigm within the XRP ecosystem. As the DeFi landscape continues to mature, particularly within the XRPL, the implications for both investors and developers are significant. The introduction of platforms like Xpfinance could signal a turning point, enabling XRP holders to leverage their assets in a secure and transparent manner while simultaneously contributing to the broader vision of financial inclusion championed by Ripple. Looking ahead, the interplay between regulatory developments, market dynamics, and technological innovations will undoubtedly shape the future of cryptocurrency. As scrutiny intensifies and new solutions emerge, stakeholders across the crypto ecosystem must navigate these challenges to harness the potential of decentralized finance. The coming months will be pivotal not only for the price trajectories of cryptocurrencies but also for the foundational principles that drive the blockchain revolution. As the industry evolves, remaining attuned to these developments will be essential for investors seeking to navigate the complexities of this dynamic market. In recent days, the intersection of cryptocurrency and global trade dynamics has captured significant attention, particularly as Bitcoin's value surges amid evolving U.S. China trade talks. This renewed optimism in the crypto market is not only being driven by international economic frameworks but also by domestic shifts in policy, particularly under the Trump administration. As the digital asset landscape continues to evolve, stakeholders are increasingly looking to capitalize on the potential of Bitcoin and other cryptocurrencies. Bitcoin's recent rise, hovering around $96,000, has been attributed to a combination of factors, including speculation surrounding the U.S. China trade talks, Investors are positioning themselves favorably, believing that improved trade relations could bolster economic stability and in turn enhance Bitcoin's appeal as a hedge against inflation and market volatility. As one market analyst noted, the correlation between macroeconomic indicators and Bitcoin is becoming more pronounced, with traders viewing cryptocurrencies as a safe haven in uncertain times. Adding to this bullish sentiment is the recent announcement by President Donald Trump regarding the establishment of a strategic Bitcoin reserve designed to integrate digital assets into the national financial framework. The executive order signed on March 6, 2025 aims to create a reserve funded initially by Bitcoin seized through criminal and civil forfeitures. This initiative, which is projected to grow the U.S. government's Bitcoin holdings to an estimated $17 billion, reflects Trump's pledge to position the U.S. as a global leader in the digital finance space. Critics, however, voice concerns about the strategic implications of such a reserve. They argue that holding a volatile asset like Bitcoin, which lacks intrinsic value and clear economic application, could expose taxpayers to unnecessary financial risks. As one economist pointedly remarked, strategic reserves are typically for stable commodities with intrinsic value. This move appears more speculative than strategic. Moreover, there are apprehensions regarding the potential conflicts of interest, especially given Trump's financial ties to the cryptocurrency sector and the political donations received from crypto billionaires. The management of the strategic Bitcoin reserve will be overseen by a newly established office within the Treasury, which will employ various strategies such as dollar cost averaging to manage the asset's volatility. Proponents of the reserve argue that it could serve as a significant stabilizing factor in times of economic uncertainty while also encouraging wider institutional adoption of Bitcoin. In addition to Bitcoin, Trump's executive order envisions a broader U.S. digital asset stockpile, which may include other cryptocurrencies such as Ether and Ripple. However, the selection of these additional coins has sparked debate, with critics suggesting it amounts to arbitrary favoritism that could distort market dynamics. By picking winners in the digital asset space, the government risks undermining the very principles of free market competition, cautioned one crypto analyst. As the cryptocurrency market navigates these developments, the implications for both investors and policymakers are profound. Bitcoin's rising value amid geopolitical negotiations and domestic policy shifts underscores a broader trend of increasing institutional interest in digital assets. The coming months will likely reveal how Trump's initiatives will reshape the landscape of cryptocurrency in the U.S. and whether they will provide the stability and strategic advantage that proponents promise or exacerbate the risks and uncertainties highlighted by skeptics. In conclusion, as Bitcoin continues to capture the public's imagination and investment interest, the evolving narrative surrounding its integration into national policy will be critical to watch. Stakeholders across the globe are poised for potential shifts in the digital asset landscape, with the possibility that upcoming developments could further solidify or challenge Bitcoin's status as a mainstream financial instrument. As this story unfolds, the convergence of trade policy and cryptocurrency will undoubtedly remain a focal point for analysts and investors alike. In a landscape already fraught with tension between politics and finance, the recent surge in interest surrounding Donald Trump's $Trump meme coin has thrown the cryptocurrency sector into a whirlwind of controversy and scrutiny. As the former president's political moves continue to shape public discourse, his foray into digital assets has raised eyebrows, particularly among lawmakers and financial analysts, with data revealing that a staggering 764,000 wallets linked to the Trump token have seen losses. The implications of this new financial venture are becoming increasingly clear. The Trump token, launched in January 2025 ahead of Trump's second inauguration, saw initial success buoyed by promotional activities, including posts from Trump himself on social media platforms. However, the token's performance has been highly volatile, with around 58 wallets reportedly raking in over $10 million each, totaling $1.1 billion in profits, while the majority of smaller investors have faced steep losses. According to blockchain analytics firm Chainalysis, these statistics illustrate a lopsided distribution of wealth among token holders, with approximately 2 million wallets having participated in the tokens trade. As interest spiked dramatically, over 50%, following the announcement of an exclusive dinner event for top token holders. The token's market cap briefly soared to $2.7 billion before retracting to around $2.17 billion. This volatility reflects not only the speculative nature of meme coins but also raises questions regarding the ethical implications of Trump's involvement in cryptocurrency. The Senate's Permanent Subcommittee on Investigations has initiated an inquiry into the ownership structure and revenue model of the Trump token amidst concerns that it may represent a conflict of interest for the president. The scrutiny has intensified with reports linking the cryptocurrency venture to foreign investors, including a state-backed Emirati fund and crypto mogul Justin Sunday. Additionally, the ethics watchdogs have voiced concerns over promotional practices that seem to blur the lines between political influence and personal financial gain. Critics have pointed out that the nature of meme coins, which thrive on social media hype and can evaporate in an instant, undermines the credibility of the broader cryptocurrency market. The backlash was palpable during a recent House hearing where Democrats walked out in protest against the perceived lack of safeguards to prevent Trump from profiting off the crypto market. This erosion of bipartisan support poses risks to future regulatory efforts, turning what was once a collaborative approach to digital asset legislation into a contentious political battleground. In tandem with the developments surrounding the Trump token, Trump has also made headlines with his executive order establishing a strategic Bitcoin reserve. This initiative aims to position the U.S. as a leader in digital finance by directing seized crypto assets into a national stockpile. However, critics argue that holding volatile assets like Bitcoin offers little strategic value and poses risks for taxpayers. The reserve's creation raises further questions about the potential for conflicts of interest, particularly as it relates to Trump's financial interests in the cryptocurrency space. As the landscape evolves, the implications of Trump's ventures into cryptocurrency will likely continue to unfold. The intertwining of politics and crypto presents a complex challenge for regulators, investors, and the public. With ongoing investigations and market volatility, the future of both the Trump token and the proposed Bitcoin reserve hangs in the balance, leaving observers to ponder how these developments will shape the intersection of politics and finance in the digital age. In a significant leap for its ecosystem, Ethereum has successfully implemented its highly anticipated Pectra upgrade, an initiative that promises to reshape the landscape of staking and wallet functionality for the blockchain. Activated on May 7, 2025, the upgrade is considered the most pivotal since the Ethereum network transition to proof-of-stake in 2022. Known as the merge. As Ethereum navigates increasing competition and internal challenges regarding its strategic direction, the Pectra upgrade arrives as a crucial response to these demands. The Pectra upgrade aims to enhance the efficiency of staking processes, improve wallet usability, and bolster the overall performance of the blockchain. One of the most notable changes introduced is the increase in the maximum amount of Ether ETH that can be staked from 32 to 2048 ETH. This adjustment allows validators, who play a vital role in maintaining the Ethereum network, to consolidate their stakes under a single node, thereby streamlining operations and reducing the overhead associated with managing multiple validators. Tim Biko, protocol support lead at the Ethereum Foundation, emphasized this point, stating, "This means that small operators can compound their stake directly while large ones can consolidate validators to reduce bandwidth use on the P2P network." The upgrade, which was executed as a hard fork that began at 10:05 Universal Time Coordinated and concluded shortly thereafter, follows a series of rigorous tests, including 2 unsuccessful attempts that had previously raised concerns about the upgrade's viability. The successful activation on the mainnet has restored confidence within the Ethereum community, which has been grappling with the challenge of losing market share to competitors such as Solana, which has attracted a significant influx of new developers over the past year. Central to the Pectra upgrade is EIP 7251, which facilitates the enhanced staking capabilities, and EIP 7702, which introduces smart account functionality to crypto wallets. This innovation allows users to pay transaction fees with tokens other than ETH and introduces new options for wallet recovery, paving the way for a more user-friendly experience. These features are particularly significant as they aim to lower the barriers to entry for new users and developers, potentially revitalizing Ethereum's status as a leading platform for decentralized applications. Moreover, the Pectra upgrade includes a total of 11 Ethereum improvement proposals (EIPs) that target various aspects of the network's performance. For example, EIP 7691 enhances the blockchain's capacity to handle more data blobs per block, thereby increasing throughput and reducing costs for Layer 2 rollups. Other proposals focus on improving data efficiency and stabilizing transaction fees, essential elements for ensuring Ethereum's scalability in the face of growing demands. As Ethereum looks to the future, the Pectra upgrade is only the first phase of a two-part enhancement, with the next phase dubbed Fusaka scheduled for late 2025. This upcoming upgrade is expected to further advance the network's scalability and security, incorporating technologies like PeerDAS to optimize performance. Despite the optimism surrounding the Pectra upgrade, Ethereum's price remained relatively stable, trading around $1,800. Reflecting a modest increase in the wake of the enhancements. This stability may suggest that market participants are still assessing the long-term implications of the upgrade amid ongoing regulatory scrutiny and competition within the blockchain space. In summary, the Pectra upgrade marks a pivotal turning point for Ethereum, aiming to bolster its competitive edge and user experience. As the blockchain continues to evolve, the community will be closely monitoring the impact of these changes and anticipating the next steps in Ethereum's ongoing development. In recent weeks, Solana SOL has emerged as a focal point in the cryptocurrency market, buoyed by a significant surge in decentralized exchange DEX activity and broader economic factors, including a $138 billion stimulus initiative from China. As the Federal Open Market Committee (FOMC) convenes this week, the convergence of these developments has created a bullish atmosphere for Solana, drawing attention from traders and investors alike. As of May 7, 2025, the total DX volume on the Solana blockchain has reached an astonishing $806.8 billion this year alone, marking a nearly 400% increase compared to the same period last year, when volume stood at $201 billion. This spike was largely fueled by a robust crypto market rally that began in November and peaked in January, with January alone accounting for over half of the total DX volume, approximately $408 billion. The impressive growth is attributed not only to the increasing adoption of Solana's ecosystem but also to the overall market dynamics, which have seen SOL's price rise in tandem with trading volume. Data from Top Ledger indicates that after the January peak, trading volumes normalized, yet the overall trend remains positive. The decentralized finance DeFi sector is evolving rapidly, and Solana is solidifying its position as a formidable player, noted an industry analyst. Jupiter Exchange has emerged as the dominant force within Solana's DX landscape, capturing $334.6 billion of the total volume, or 55%. This positions Jupiter well ahead of its nearest competitor OKX, which accounted for only 5.21% or $32.2 billion. Interestingly, even niche platforms like the memecoin launchpad Pump.Fun have made significant contributions, facilitating $22.3 billion in volume, underscoring the diverse nature of trading activity on the network. Solana's rise has not gone unnoticed. In the first quarter of 2025, it was the second largest blockchain by DX volume, following Ethereum, which commanded 30% of the market. Solana's share came in at an impressive 23%, reflecting a growing preference for its high-speed and cost-efficient transactions. As the competition in the DeFi space intensifies, Solana's ability to sustain its momentum will be critical to its long-term success. In addition to the impressive DEX volume, The ecosystem has been bolstered by significant financial maneuvers, including the successful ICO of a Solana Layer 2 project that raised over $33.5 million. This influx of capital into Solana-related initiatives indicates strong investor confidence and a burgeoning interest in decentralized applications built on its blockchain. As the FOMC meeting approaches, market participants are keenly monitoring any potential shifts in monetary policy that could impact the cryptocurrency landscape. The combined effects of the Chinese stimulus and anticipated decisions from the FOMC could create a perfect storm for Solana and the broader crypto market, further propelling adoption and investment. Looking ahead, the future seems promising for Solana as it continues to capture the interest of investors and developers alike. With its DEX volume milestones and ongoing ecosystem developments, Solana is positioned to not only weather the market's fluctuations but also to thrive in an increasingly competitive environment. The coming weeks and months will be crucial in determining whether Solana can maintain its upward trajectory and solidify its place within the cryptocurrency pantheon.